Good afternoon. My name is Carolyn, and I am a senior manager on the Food and Forest team here at Ceres, and I am your moderator for today's session. Today, we are talking about the corporate use of carbon credits. Before I begin today's session, I have a few notes on logistics. As you just heard, this session is being recorded, and we will be providing a link of the recording to all of the participants after we complete today. We do have time for Q&A later on in the agenda, so if you have questions, go ahead and use the Q&A box in your Zoom screen. And if you're having any technical issues, such as trouble with audio, also please type that into the Q&A box and we will try and help you troubleshoot on this end. Next slide, Rachel. I'd also like to take a moment today to respectfully acknowledge the ancestral and unceded territories of all Native and Indigenous people in the US and globally who have stewarded our lands for generations with attention to sustaining communities and the environment. We do this land acknowledgement at Ceres to affirm our commitment to recognize, respect, and uphold the rights of Indigenous people around the world, and including through our work. Actually, further on in this session, we'll discuss the rights of Indigenous people in the context of carbon projects. And on the next slide, Rachel, for those of you who don't know Ceres, we are a nonprofit organization based in Boston, Massachusetts. And as you just saw on the last slide, that's Massachusetts land. We are a nonprofit working with the most influential capital market leaders to solve the world's greatest sustainability challenges. In particular, we work with investors and companies to drive action and inspire market-based policy solutions throughout the economy towards a just and equitable future. Next slide, Rachel. So for today's event, we have a really fantastic panel of speakers. We have Stephen D'Onofrio, who is the program director at Ecosystem Marketplace. No, sorry, he's the program director of Ecosystem Marketplace and Supply Chain Initiatives at Forest Trends. And Ecosystem Marketplace is responsible for the State of the Voluntary Carbon Market Report, which is an invaluable resource for carbon market data and analysis. Maria Garcia Espinosa is the Senior Policy Advisor at Climate Law and Policy. Maria works with tropical forest countries to design and implement integrated landscape policies to help them transition towards a low carbon pathway. You may also know some of these landscape policies like RED programs to avoid deforestation. James Smith is the Director of Natural Climate Solutions at WBCSD and the technical lead at Natural Climate Solutions Alliance. In both of his roles, James works to provide guidance to companies on how to credibly integrate natural climate solutions into corporate climate strategies. And finally, we have Christopher Weber. Chris is the Global Head of Climate and Sustainability Research at BlackRock Sustainable Investing. And he leads thought leadership on climate and sustainability. Previously, Chris held positions at World Wildlife Fund and the Science Based Targets Network. I am especially grateful today for our panelists for joining us and thankful for them to share their views. Next slide. So today we are launching a new resource. It is titled Evaluating the Use of Carbon Credits, Critical Questions for Financial Institutions when Engaging with Companies. And this is a report for investors and banks, and it sets out guardrails on the use of carbon credits and highlights how carbon projects can avoid exacerbating social inequalities. We provide critical questions for investors who are interested in evaluating and engaging portfolio companies, and for banks who are interested in engaging with their clients on corporate climate commitments and the use of carbon credits. So in today's session, Stephen is going to give us an overview of the trends in the voluntary carbon market. And then we're going to turn to a conversation with all of the panelists, and we'll talk about net zero commitments, the role of carbon credits in those commitments, and how carbon credits can contribute to a just and equitable transition. We also have time on the agenda for audience Q&A. So with that, I'm going to pass the floor to Stephen.
Great. Thanks so much, Carolyn. guess we could go to the first slide. There we go. Okay. Yeah, thanks for having us here today, working very closely with Ceres over the years. Great to see this, all coming together to provide, the private sector with the resources that they need to make these decisions. It's a little bit of a moving target, as we know, as this market is evolving, rapidly. It's been evolving for the last, roughly 3 decades. But, we hope that our ability to engage the market, collect primary confidential data from a growing network of respondents, about their sales and the dynamics of their transactions, will be an aid in this process. And I'll talk through some of the data we have today. And then, I think a bigger kind of point, from our side here is that there's a growing consensus that we need to have fuller end-to-end, market transparency. We sit on the side where we say this is what the data tells us, but the rest of the market is saying we need to know more, and there are gaps in transparency that need to be filled in a productive and pragmatic way, where there's opportunities for accurately telling climate strategies and stories around achieving goals, through the use of offsets, but really contextualized into the broader, carbon management strategies of companies. Anyway, we go to the next slide, and just to talk a little bit more briefly about the kind of our methodology, where the data comes from. We're actually in the process right now of truing up full calendar year 2021 data, but back in September, October, we had close to 200 organizations reporting data. These are project developers, investors, intermediaries that report their credit sales to us. This number has been increasing, year on year for the past several years. A number of reasons for that. Obviously, there's new actors in this space, but there's also just a lot more activity happening on a regular basis. So we're really excited to see this and appreciate, the transparency that these organizations provide. What they represent are, headquarter locations, 40 plus different countries, hundreds of projects from 80 plus countries. So even though the name Forest Trends is the organization, we cover all project types and categories. And I'll talk a little bit through some of the differences in the data that we have, in that context. And increasingly, information about buyers is being shared. We do not, this is confidential data being provided to us, but we do have information that try to provide a glimpse into how the demand side of the market is approaching this, what they're paying, what's driving, buyer interest. Let's go to the next slide. And I know I don't have a lot of time. There were a lot of, I think hot topics that I wanted to try to touch on. I'll try to hit these a little bit in briefer terminology and also data points, but I do think, we need to reflect on, continue to reflect on the past, 15, 20 years of this market. It's not a, this is not a market that's been around for hundreds of years, had time to work through the kinks, but, we are for sure seeing an exponential kind of growth pattern happening. And some of the data that's coming in now is really showing that we're in the process of truing up that 2021 data, which is coming from existing respondents, new respondents. And also we're seeing diversification, in the market and how transactions are kind of changing hands, or credits are changing hands. And, it's still prominently an over-the-counter, bilaterally negotiated type of market, either from, project developer to an intermediary, project developer to an end buyer. But we do see, the role of exchanges coming back into play, just like we did in the mid to late 2000s with the Chicago Climate Exchange, those yellow figures there back in those years. And starting to see sort of the interest from some buyers in this diversifying and growing buy side to buy just standard contracts that meet certain specifications. But still, even, in a lot of those cases, we're seeing the majority of interest are in specific attributes of projects, specific even projects. So no, not just a ton is a ton, but that there are benefits, to the buyer, perceived benefits, and what drives additional value for those buyers is determined by, the underlying elements. So we published our first report back in September of last year, which covered roughly the first 3 quarters of the year, 2.5 quarters. And then we published an update during COP26, where we finally saw for the first time ever, this market had achieved that $1 billion mark that we were always looking for, waiting for it to happen. We knew it was there. We knew it would come last year, and it wasn't even full year of trading activity. So, we'll be publishing our full results of 2021 very soon, in the next month. But for now, I can just say, the growth has continued. We've saw the numbers that we published during COP showed not only an increase in volumes and in market value, but the majority of that, about 61%, was driven by natural climate solutions type of projects, and we'll talk through those definitions on the next slide. But also even better, and to the point of the comments I've made before, is the projects with co-benefits were achieving roughly 2.5 times the price of projects that did not have co-benefits certified. So that would be anything from social safeguards to biodiversity and other ecosystem service benefits. So I think this is compelling for us in terms of understanding the spreads in the market, where you have highs and lows, but the global averages, when you have 300 million tons being reported, and the global average price of somewhere between $4 and $5 a ton, that there will be credits there that are very cheap and are being sold, and doesn't mean that they're bad quality, just means that that's the price for those credits. Then there's other credits that are much higher. So for forestry and land use as an example, and we can go to the next slide. Forestry and land use as an example, we saw prices so far in 2021 of less than $1 to almost $200, and this is just for that that category here, which we see natural. So I think one of the things in terms of trends that I think is worth highlighting, as I've broken these 2 groups out into themselves, is that we historically would have agriculture within forestry and land use, but we're seeing the market for agricultural projects, ticking up. There's more actors, transacting those credits. There's also more credits and supply coming out to the market. But comprehensively, what's sort of very interesting to see is that in 2020, natural type of projects, NCS projects, was about 28% of the traded market. Based on data that we reported, in September of last year, that split was more 50-50. Now, full year 2021 is not complete, but if that remains consistent, for the entire data set, I think that's a clear signal that the market is starting to really push towards these natural climate solutions type of projects. And despite the fact that, as you can see on the screen, they have an average, price per ton that's higher, from non-NCS projects. So we can go to the next slide. And I realize there's much more data in terms of project types than what we see on this screen, but these are just a few examples. And this is continuing, with new data coming in, where we see the prices for NCS projects remaining higher than non-NCS projects, except for certain categories. We might see some particular interest in clean cook stoves or household devices. And the breakdown, though, as other types of projects from blue carbon, which are more costly to develop in some cases, but there's more appeal, more interest from the demand side. So as supply of other types of NCS projects come online that are not exclusively terrestrial, I think we'll start to see that being factored in here, and we'll kind of differentiate those from the rest of NCS projects. And those will, those are showing to be higher priced than some of the sort of terrestrial restoration projects. But a lot of the renewable energy credits you see here are originating in India, China, economies where there's still opportunities to develop new projects based on the emerging standards or emerging requirements from different standards that new project development of renewable energy credits is not allowed anymore in developed economies. And in the interest of time, we can go to the next slide. So this pulls out 2019 data, which I'm showing this here because we published this last year. We haven't published 2021 data, but I will talk to it. But it's really interesting to see where these credits are coming from. We can also map this, to pricing. So, what are the prices based on country location, and we can, add another variable or two variables to also add in standard and other things. But as you can see here, this is looking specifically at forestry and land use credits. The countries that you might expect where these credits would come from: Indonesia, Peru, Kenya, Brazil, United States, etc. In 2019 calendar year, those transactions, those are the top countries. In 2021, we're seeing, pretty similar data. Actually, I won't give specific numbers, but Indonesia it looks like it's been surpassed by Peru. Again, full data hasn't come in, but, those top two are sort of changing hands, it looks like, followed by the DRC, and then Kenya, Brazil, USA, and Zambia. So we'll be finalizing all of that in the near future and producing some new information on this. But technological projects actually look fairly different with countries like India, Brazil, Mexico, South Korea, US, and China being the largest countries where those credits are coming from. We can go 2 slides more just in the interest of time. This slide I'm talking about the corporate sectors, I think is there's a few kind of important notes here. So we asked the sellers to provide us with counterparty information, which if we do not get specific buyer names that are end buyers, we get details about the sectors, locations, which is really informative to understand who's willing to pay for certain types of credits, where the trends taking place in terms of sectors, but also to get a better picture about financial flows, and even if it's not an investment into the project itself, to develop the project, if they're purchasing credits, from a certain project within a particular country, that's really powerful information to kind of show the dynamics of the market. And when you look at this year to year, these percentages really change. So again, this is 2019 buyer sectors for forestry and land use. In 2021, the numbers as we published back in September actually show that the energy sector is the #1 buying sector. Because we have historical data, if you go back to 2018 was the last year where the energy sector was the #1 sector purchasing credits. So there's a few years in between where they were not at the top of the list, and this is why we started adding in new metrics around the contract structure to understand how much of the market that's trading at spot versus maybe strips of spot and futures. To meet future demand, and then also to differentiate that buyer use case if they're buying for their own use or buying to resell as a potential, as a lot of companies are developing trading desks and to be to serve as intermediaries, not just for their own consumption. And so there's more information about buyer sector, which I think are really interesting. Just that forestry and land use credits seem to be very appealing to companies in the consumer goods that are consumer facing type of businesses. and as well as the extractives. So, where there's either a large sort of interest from a stakeholder to be able to, talk through a project that's, nature-based, or to be able to have large supply of credits, such as companies in the energy and utility sectors. On the other hand, technological, types of projects are not, it's very much almost the inverse for consumer goods companies. But we see, strong interest in those types of projects from companies in the energy sector, companies in, finance and insurance, as well as a few other kind of key sectors. So I probably should go to the next slide. And then there's a lot of information that I know has already been published by the Ceres team about the different types of standards and crediting, certifications that are available, from this core carbon, credit standards, to these standards that integrate social environmental safeguards into their carbon crediting and issuances, and then others that are kind of add-on certifications that are just exclusively about social and environmental sustainability. So we can go to the next slide. Again, this is a chart showing data from 2019. We do have, some updating data. I don't have this available at this time. The team is, feverishly, working through a lot of new data coming in for 2021, which I'd hope to have ready for today. But I think the signal here is that when we kind of segment out from that last slide, standards like Plan Vivo, Gold Standard, VCS with an add-on of climate, community, and biodiversity, and this is before new certification schemes like SD Vista from Vera were launched. But it's a combination of higher volumes or lower available supply and higher prices for those types of credits that are rich with those additional attributes. And so that's been something we've seen for a long time, and I think it's really just in the last year, 2 years, that we're seeing prices really start to shoot up for credits that have those additional co-benefits and attributes that are certified. And then I guess this is the last slide here, is just the buyer countries. So I mentioned those counterparty attributes, and this also is a bit of a I guess a moving target in some cases, where just like project location might vary, so will projects, buyer sector and buyer countries. And the UK, European companies, European-based companies have been predominantly the largest, kind of group in terms of geographic, in terms of buying credits, and particularly obviously for a larger supply of nature-based credits. The United States is a little bit more split, with buying credits from nature, buying credits from technological projects. And so then that's largely due because of the origin of that supply. We published some research last year that showed how buyers from Europe were buying large, projects or large amounts of credits from nature-based projects from the countries that I mentioned before that are those large sources, whereas the United States is able to purchase a large supply also from homegrown credits that are from a more diversified set. I know I've gone far over my time, and there's a whole lot more into the weeds I'd love to get to. Don't have the time for that, but I'm happy to answer any questions. And thanks to my co-panelists for letting me take a bit of extra time here. Thanks.
Thank you so much, Stephen. Yes, there's so much data and information, and we appreciate you sharing those top lines. For folks who are curious about all of this information, Ecosystem Marketplace has lots of data, and I'm sure there will be a report coming out soon with the newest information that Stephen mentioned. So we're going to transition to our panel discussion. And so if you do have questions for Stephen, type them into the Q&A box, and we will try to get to them towards the end of our, when we get there. Rachel, can you bring us to the next slide? So Stephen mentioned that there's been an uptick in the voluntary carbon market, and a lot of this is tied to an increase in net zero commitments. Last year, we saw a rise in excitement around net zero, but that wave was also met by an equal amount of criticism and skepticism. And we know that weak net zero commitments can put investors and their companies at risk. So when we look at a strong net zero commitment, we're looking for a long-term net zero target that is for 2050 or earlier and is aligned with a 1.5 degree C pathway. We're also looking for an interim science-based target that covers the entire value chain, scope 1, 2, and 3, and then for a transition plan for how the company is going to achieve those targets. So to kick off this panel discussion, Chris, I want to come to you first. Why is it important for investors that companies set out strong net zero commitments?
Well, thanks, Carolyn, and thanks for the invitation to be a part of this panel. It was a great and insightful presentation from Stephen already. So, I mean, at BlackRock, we are obviously coming at this from the perspective of an asset manager. We see that climate change has become a critical factor in companies' long-term profitability across sectors. So, because of that, we look to company leadership to disclose to investors, our clients, how climate risks and opportunities are going to impact their business and how these factors are addressed in the context of a company's business model and sector, just like you've talked about here in the terms of climate transition plans. So within this broader context, we seek to understand how companies' plans, to intend to deliver long-term financial performance throughout the energy transition and the transition to a net zero economy, consistent with their business model, their sector, their geography. In our recently updated stewardship global principles, we published these in December. We ask that companies define short, medium, and long-term GHG reduction targets, science-based where possible for their sector, alongside a variety of other TCFD and SASB related disclosures. And we do this because when companies disclose these short, medium, and long-term targets, we're better able as investors to assess the long-term performance of our clients' investments. And so in that vein, we also ask the companies disclose alongside these targets their business strategy and how those collectively are going to affect the economic interests of their shareholders, who are our clients.
Thanks, Chris. And I think that yesterday's IPCC report really affirms that the climate crisis is worsening. There are impacts that are present today that generate risks for companies and investors. And so really having a strong net zero commitment and then taking the action today is really important. So I think, as you say, that's very clear. Next slide, Rachel. So James, turning to you, the Science-Based Targets Initiative has made it very clear companies cannot use carbon credits to reach their emission reduction goals. Rather, companies need to prioritize reducing their value chain emissions that follow an emission pathway that limits warming to 1.5 degrees C. And in this graph here on the screen, that pathway is represented by this orange curve. And then company emissions need to be under the orange curve, so that is represented on this graph by those dark gray bars. And as companies reach their emission reduction goals around, say, 2040, 2050, residual emissions, which are the emissions that can't be abated, those must be neutralized with carbon removals only. So does this mean that there is no role for carbon credits in the carbon market in helping to achieve the goals of the Paris Agreement?
Well, thanks, Carolyn, for the question. And of course, it's a pleasure to be here to discuss this topic with you all today. I guess in short, to your question, is there no role for carbon credits and the carbon market in reaching the Paris Agreement? The answer is no, absolutely not. There is a very strong role for high quality carbon credits from helping us reach the Paris Agreement goals. So first things first, of course, though, we absolutely agree that the priority for companies must be to decarbonize both their operations and their emissions from their value chain. And we need to do, individual companies need to do this, and we need to rapidly decarbonize the entire economy effectively. And the sooner that we do this, the better from a climate change perspective. But high quality carbon credits can and must play an important role in achieving the goals of the Paris Agreement. So as first things first, I guess, many companies will be unable to totally eliminate their greenhouse gas emissions at the point at which they get to a state of net zero. And as you've noted, Carolyn, these residual emissions need to be balanced out by an equal amount of carbon removals. Now, many companies will not have the opportunity to generate these carbon removals from within their value chain, and therefore high quality carbon removal credits will be necessary for them to balance or to neutralize these residual emissions. So that's these bars under the x-axis in purple here. Now, of course, these high quality carbon removals can come from nature-based solutions such as forest restoration, or from technological solutions such as direct air carbon capture and storage. Now, secondly, there's a second role in which carbon credits can help us reach our Paris Agreement goals. And that is that companies with the most ambitious climate change mitigation strategies can go above and beyond the necessary decarbonization they need to reach net zero and a 1.5 degree pathway by investing in high quality carbon credits outside of their value chain as well. If that would be represented by the paler gray bars under the x-axis on the left-hand side here. So, for instance, this would include retiring carbon credits equal to a proportion or covering all of the company's annual unabated emissions, an action which we would typically kind of consider being carbon neutral. Now, this, of course, helps make a critical contribution to limiting climate change, not just at a corporate level, but at a global level. It helps us reduce the total amount of carbon in the atmosphere and therefore help limit global warming to 1.5 degrees. Importantly, of course, this also provides an important source of financing to projects that provide climate mitigation, resilience and sustainable development impacts and outcomes, for instance, like conservation and restoration activities. So it's an absolutely critical way in which we can help build resilience for the future. So in short, carbon credits are critical to help us both at a corporate level and a global level reach the Paris Agreement goals.
Yeah, thanks, James. And I think there's also the carbon markets help bring an important level of source of finance to some of the areas where they're working on reducing emissions. Chris, I want to turn back to you really quickly. We've laid out here, how carbon credits should fit into a net zero commitment. Can you talk about what the role is of a financial institution in ensuring that companies are using carbon credits appropriately? Why does BlackRock feel this is an important issue to address? And how has BlackRock's thinking on this evolved or developed in the recent years?
Sure. Yeah, just building off a lot of what James already said, generally speaking, I think we're very supportive of companies' decisions to invest in technologies and solutions beyond their operational emissions reduction goals, which we call for in our stewardship principles. We very much recognize that carbon credits are one of the primary vehicles for companies to do such kind of above and beyond mitigation today. And so, in a nutshell, that's why we are engaging on this issue. When companies do, want to go above and beyond in our stewardship, basically, we ask them to disclose how they are using such credits and such key information around them, because that better allows us as investors to understand the why and the how of what companies are doing with carbon credits. I should note, in addition to our stewardship with companies, we're also recognize there's a lack of standardization in the market to enable such credible disclosures. So as such, we really welcome a lot of the recent work that's being done to develop standardized, transparent, verifiable approaches to companies being able to interact with the voluntary carbon markets. In general, we think this standardization will kind of give us as investors an additional benefit to understand how, again, the kind of why and how of companies are interacting with these markets. And just to echo what's on this slide and what's already been said, we definitely agree and see that carbon companies' purchase of carbon offsets or voluntary credits as a complement to, not a replacement of, the substantive and sustained long-term emissions reduction plans that we hope to see in their disclosures.
Yeah, thank you, Chris. And I we're hoping that this guidance can be a starting point for companies in looking at disclosures, especially as that standardization begins to emerge and evolve. On the next slide, Rachel. So we have different types of carbon credits in the market, as Stephen has talked about already in his presentation. We have those that reduce emissions and those that remove emissions. And in this carbon credit taxonomy, we have a few different examples of the different types of mitigation activities that reduce or remove emissions. James, turning to you, can you talk through how reductions and removals both contribute to limiting warming to 1.5 degrees C?
Yes, absolutely. I guess, to start with, we need to make it clear that to meet the goals of the Paris Agreement, we need to deeply reduce greenhouse gas emissions we put into the atmosphere and to decarbonize in the near term. And we've seen that on the previous slide where we saw kind of the strength of the slope of the orange line. And secondly, we desperately need to draw carbon dioxide out of the atmosphere as well. And you're right, there's been a lot of debate over the relative role that emissions reductions and removals can play, particularly when we think about the use of carbon credits. And the importance of removals has been given further boost by the launch of SBTi's net zero standard. As we've already seen, it's removals which can be used in neutralizing residual emissions. And that was the little purple bars under the line in the previous slide. And based off of that momentum around removals, we're seeing a lot of momentum on tree planting schemes, et cetera, et cetera. But the reality is, it's not a question of either or. We need both emissions reductions and removals if we're to limit climate change to 1.5 degrees. And we need to desperately invest in both. That's the headline answer to the question. But there is a nuance there. And that is, although we need both, there are important issues that affect the relative timing of the importance of emissions reductions or removals. So for example, it makes very limited sense to focus efforts in the agriculture, forestry and land use sector, so anything to do with land mitigation, on just removals at the moment, where we still see rising emissions from this sector. And all of the modeled pathways that we see for us to reach a 1.5 degree pathway require that we halt deforestation, we halt the release of emissions from nature into the atmosphere. So that means that if we don't invest in emissions reductions now, actually down the line, we'll be needing to invest in even more restoration activities to make up for that near-term failure to avoid emissions from these habitats, etc. And of course, that leads to a lot of knock-on consequences. If we need to invest more in restoring land using natural, forest restoration or other activities, this requires much larger areas of land than actually protecting the existing forests, which are very rich, dense stores of carbon. And of course, that then can lead to trade-offs and conflicts with regards to, e.g., land use, food security, agricultural production, etc. So it is important, we do need both emissions removals and reductions, but the timing of both of these actions is perhaps not equal. Certainly in the near term, we desperately need to focus on avoiding emissions, and particularly those that come from natural sources. And then there's a second point as well I'd like to bring in here. It's moving a little bit away from climate, but we're also facing a biodiversity crisis, and we recognize that will also have phenomenal impacts on society and the future resilience of the socioeconomic systems that we find ourselves in. And therefore, there is there's an additional incentive or imperative that we invest in emissions removals now and the avoidance of carbon emissions from natural habitat degradation in the near term, to ensure that we're not also degrading our biodiversity and biological diversity. So in short, we need both emissions reductions and removals, but certainly in the near term, and certainly when we think about natural climate solutions, it's important to prioritize emissions reductions.
Thanks, James. And actually, I had a question for Chris. I wanted to ask you, Chris, about this shift in the discourse discourse towards technological removals. And I think James touched on a lot, but wondering if you have anything to add here. Is there a role for natural climate solutions in this landscape when we hear so much conversation about the technological removals?
Yeah, and we actively engage companies on both climate and natural capital within the general, the general vantage point that, as James was talking about, the sort of that biodiversity and natural capital represent material risks to company performance equally with climate. And I would just add to everything that James said that, sort of we see two key roles for how natural climate solutions, nature-based solutions, whatever you want to call them, kind of fit into this overall picture. And it kind of depends on what type of company we're talking about. For companies that do have material dependencies and impacts on nature, such as those with material deforestation exposure that James mentioned, we're kind of looking for them to disclose how their decisions to invest in natural climate solutions kind of as part of their operational reduction goals kind of fit into their climate strategy. And for those that maybe have less material dependencies and impacts on nature, we're kind of, again, looking for companies to use NCS as an above and beyond strategy, going beyond what they should be doing with respect to their operational reduction targets.
Yeah, actually, thank you so much for pointing that out. The within the value chain and outside of the value chain concept, making the distinction there. And actually, we did have a few questions in the chat, so I appreciate you flagging that. Let's see, Rachel, can you move us to the next slide? I want to kind of transfer to talk a bit about NCS projects specifically, and we've sort of been diving into it. And Maria, I want to jump to you. When a company is purchasing carbon credits, what are the characteristics that make nature-based carbon credits high quality?
Thank you, Carolyn. Thank you for the invitation and for the interesting conversation. And I guess I'll piggyback on what Stephen already mentioned. No, there's all this interest and it's increasing demand from companies on nature-based carbon credits, and it is expected to increase even more by 2030. And it's important to understand that a lot of those high-quality nature-based carbon credits are coming from national and subnational governments who are engaging more and more in the voluntary carbon market. So over the more than 10 years, a vast number of national and subnational governments started designing large-scale and cross-sectoral policy interventions that are geared precisely at reducing deforestation and transforming rural economies to more sustainable land use practices. So of course, the potential social and environmental benefits of this scale of interventions is massive, and these jurisdictional emission reduction programs, ER programs, RED strategies, whatever you want to call them, they entail a combination of context-specific policies and measures. So implementation is very, very different from a project scale implementation of any kind of project that has been involved in the voluntary carbon market. What makes a carbon credit from a nature-based intervention of this scale high quality? And I guess from the technical standpoint, the concept of environmental integrity of a nature-based carbon unit has been often associated to the robustness of forest monitoring and carbon accounting methodologies at that scale, at the national level or at the subnational level. And it is through the use of these methodologies and technical solutions that have been used to reduce the risk of double counting, leakages, and permanence, for instance, having in place emission reductions registries or buffers for blocking percentages of emission reductions in case of, non-permanence of leakages. These kind of solutions have been considered as key to really ensure the credibility, the robustness, and the permanence of those emission reductions that are being achieved by these jurisdictional programs. But because of the scale of the transition, these ER programs, they are pursuing social, environmental, and development benefits at the landscape level. Countries like El Salvador, for instance, are pursuing adaptation approaches to RED implementation so that they can enhance social resilience and improve water management. Other countries like Ecuador are transforming their agro-food systems at the structural level through a transformation of their policies and their incentives. And they are engaging also indigenous peoples and local communities on the ground conservation and sustainable management efforts. And other countries, like in the case of Ghana, they are engaging the private sector and local producers to transform the cocoa production system. So the implementation and the kind of benefits that these large-scale interventions are having can be very different, but it's incredibly vast. So I guess the challenge now is how to really demonstrate that those credits that are being generated by these jurisdictional programs are really environmental and socially sound.
Thanks, Maria. Yeah, and thanks for kind of diving into that. When you, in your experience, you've mentioned jurisdictional programs when you're working with countries for them to develop these jurisdictional programs for addressing deforestation. What safeguards are they applying to ensure that the social and environmental integrity results in a high quality credit? And you're on mute still.
I unmute myself. Okay, so, well, as I was saying, the issue of the scale of the implementation of these programs is really important to understand when we are trying to figure out what it takes to generate a nature-based carbon unit that is high quality at this scale of implementation. And I guess in that sense, it is good to remember that back in 2010, under the Climate Change Convention, there was this agreement on the development of a financial mechanism to provide results-based financing at the national and subnational level. So this is what we refer to as RED. And this is basically an incentive for the countries through national governments to reduce emissions. As part of this formal process at the multilateral level to develop a framework to implement RED, there was an agreement on a set of social, environmental, and governance principles that are known as the Cancun Safeguards. And the Cancun Safeguards basically constitute the minimum set of principles that all national RED implementation should be meeting. And they cover a broad range of issues from governance to policy integration, to accountability and transparency, access to information and redress of grievances, participation, equity, and social inclusion, including on issues on human rights and indigenous peoples. And they also look at issues related to the promotion of biodiversity conservation and other social and development benefits. So it's a broad range of issues that is being covered in these principles that we know as the Cancun Safeguards. When countries have been designing these emission reductions programs or the RED strategies, they have gone through complex and lengthy processes to really customize these principles and anchor them into their governance frameworks. No, this is implemented by national governments, so it is complicated to understand that a traditional project level standard can apply when it comes to national legislation. So it has been a process to really customize these Cancun Safeguards and anchor them in a way that they can be enforced through this combination of policies that are being implemented at the jurisdictional level. And in that sense, we have to date over 20 countries that have been making their reports on the implementation of Cancun Safeguards available through the official platform in the UNFCCC webpage. And of course, there are a diversity of results on how social and environmental performance is. And also, I guess, there's this issue about the standardizing reporting, and reporting parameters are very diverse. So I think Chris was talking about this lack of a standardization, and I guess this is one of the biggest challenges in this case. Standards, for instance, the RED Environmental Excellence Standard trees has been attempting to provide some kind of a standardization in this sense. They unpacked the Cancun Safeguards into common themes and indicators. And in a way, this is trying to provide the confidence on the social and environmental quality of those nature-based units that are being issued under the standard. So this is a good starting point to just generate these insights to the investors on how this could look like in a more standardized way. But still, as I was saying, the high level of customization that is really needed to adapt the diversity of social and environmental and governance issues that are making a carbon credit high quality, it would depend on the country's specific particular circumstances. So still issues about free, prior, and informed consent, distribution of benefits, land tenure, or ownership of emission reductions, and other concerns about equity and inclusiveness, they will have to be understood on a case-by-case basis in each one of the countries. So I guess that is the other challenge now, no? How to really reconcile these different concerns and expectations from investors, from the companies, in relation to high quality nature-based credits in a way that it's not creating new standards or new additional requirements to those jurisdictions that are already generating these credits, no? From a historical perspective of transformation that they have been implementing.
Yeah, thanks, Maria. And you're right. And I think that one of the things that we highlight in our report, and thank you so much for setting me up, but in our report, we highlight about 8 key principles for the safeguards that companies, that carbon projects should be achieving. You highlighted some of them, things like free, prior, and informed consent, respect for Indigenous people, you know, et cetera. And we have about 8 of them. And there are a number of standards. You mentioned the Architecture for REDD+ transaction standard art trees. And along with that, there are a few others that also address safeguards. And in our report, we actually look at the different, highlight the different social and environmental safeguard standards that look at those aspects of projects. So companies can use that as a resource. But Stephen, quick question over to you. For people who, you know, now they want to make sure that their projects have social and environmental safeguards in place, where can they look? What should they look for when they're purchasing those credits on the carbon market?
Yeah, I mean, I think there's certain standards, as that one slide indicated, that they are integrating into all of their carbon credit issuances, you know, required approach towards incorporating the values of other environmental factors, as well as biodiversity, Indigenous people, and other kind of co-benefits. Those would be, you know, Plan Vivo, gold standard, and then others are depending on add-on certifications that you could look for, such as SD Vista, social carbon, CCB, climate community biodiversity, and those are kind of known, trusted third-party certifications that you add on top of a carbon credit standard issuance, and then that allows you to kind of bundle together the attributes together from 2 different sides of a certification, one for carbon climate, the other for the co-benefits. We do ask for data as it's reported on a project ID basis, so that allows us to ensure that the quality of the reporting, you know, aligns with the information about these projects. So we can also filter this, which I didn't do for this presentation, to show you know, which SDGs, for example, if they're added on to carbon credit projects, you know, might be more appealing to certain buyers or attract higher prices. But hopefully that answers the question.
Thanks, Stephen. And we are running close to the top of the hour, but I do have one last question for Chris, and then we'll open it up for audience questions. So Chris, in our report, we recommend that companies set strong net zero commitments. They should have a climate transition plan, and they should anticipate using carbon credits for neutralizing, they should have a climate transition plan, and they should explain how they anticipate using carbon credits for neutralizing emissions. And Rachel, if you move us to the next slide, this is up there. And then when companies invest in carbon credits, they should be doing it to support mitigation beyond their value chain, not to meet their net zero targets, and they should be purchasing high quality credits that provide social and environmental safeguards. So Chris, why is it important for BlackRock that companies make these disclosures?
So again, I may be a broken record here, but just echoing, I think what has already been said by me and other panelists. I think what's important to us as long-term investors is sort of understanding how and why companies are buying carbon credits, and on top of their operational emissions reductions. disclosures like the ones listed here, you know, and things we've pointed out and being interested in, such as how the underlying projects are evaluated and assessed for permanence, additionality, double counting, leakage, you know, all of the key issues around carbon accounting of these projects. We want to know this stuff because it helps us understand, and of course our clients who we work on behalf of, how companies are taking into account these issues and make sure that the investments they're making in these carbon credits are achieving the stated purpose that they are buying them for.
Yeah, and I think one key thing as well is that transparent disclosure from companies allows us to really understand the integrity of their climate commitments, and it allows us to understand that they're making to make sure that they're making meaningful progress towards their commitments. And so there's transparency on both sides of the coin. So we are actually 2 minutes to the top of the hour, and I know that our panelists have places to be afterwards. There are many audience questions, which I wish we had time to get to, but I suspect we won't really be able to have it. So what we'll do is we'll take all of these questions and then we'll do our best to get back to you following this webinar. And I apologize, we had a really rich discussion amongst all of these folks, and I'm sorry that we're not able to get to them. Rachel, if you bring us to the next slide. So as I mentioned, this webinar today is for the launch of a new report that we had come out today about evaluating the use of carbon credits for financial institutions. And you can download the report. My colleague Courtney is going to drop a link into the chat for you. You can download the report at that link. If you have follow-up questions, please feel free to reach out to me by email. If you are an investor and you're looking to engage with companies on their carbon credit usage, please email our little email address here, which is ffinvestorengagement@ceres.org. And otherwise, yeah, stay in touch. If you have any last questions, drop them into the chat. We will do our best to get back to you following the webinar. Thank you so much to Chris, James, Stephen, and Maria for joining today, and all of your expert knowledge, perspectives, and input. Really appreciate it.
It's a pleasure. Thank you.
Thank you.
Thanks all. Bye.